Washington. The Federal Reserve on Wednesday held its ground on interest rates, again deciding not to cut as it continues a battle with inflation that has grown more difficult lately. In a widely expected move, the U.S. Central Bank kept its benchmark short-term borrowing rate in a targeted range between 5.25% to 5%. The federal funds rate has been at that level since July 2023, when the Fed last hiked and took the range to its highest level in more than 2 decades. The rate-setting Federal Open Market Committee did vote to ease the pace at which it is reducing bond holdings on the central bank's mammoth balance sheet, in what could be viewed as an incremental easing of monetary policy. With its decision to hold the line on rates, the committee in its post-meeting statement noted a lack of further progress in getting inflation back down to its 2% target. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%, the statement said, reiterating language it had used following the January and March meetings. The statement also altered its characterization of its progress toward its dual mandate of stable prices and full employment. The new language hedges a bit, saying the risks of achieving both have moved toward better balance over the past year. Previous statements said the risks are moving into better balance. Beyond that, the statement was little changed, with economic growth characterized as moving at a solid pace amid strong job gains and low unemployment. On the balance sheet, the committee said that beginning in June it will slow the pace at which it is allowing maturing bond proceeds to roll off without reinvesting them. In a program begun in June 2022 and nicknamed quantitative tightening, the Fed had been allowing up to $95 billion a month in proceeds from maturing Treasuries and mortgage-backed securities to roll off each month. The process has resulted in the central bank balance sheet to come down to about $7.4 trillion, or $1.5 trillion less than its peak around mid-2022. Under the new plan, the Fed will reduce the monthly cap on Treasuries to $25 billion from $60 billion. That would put the annual reduction in holdings at $300 billion, compared to $720 billion from when the program began in June 2022. The potential mortgage roll-off would be unchanged at $25 billion a month, a level that has only been hit on rare occasions. QT was one way the Fed used to tighten conditions after inflation surged, as it backed away from its role of assuring the flow of liquidity through the financial system by buying and holding large amounts of Treasury and agency debt. The reduction of the balance sheet roll-off, then, can be seen as a slight easing measure. Markets will be listening for Chair Jerome Powell's news conference at 2:30 p.m. Eastern Time for further clues on where the Fed is heading with interest rates.